On a single morning, one single company raised more capital than almost every other IPO in financial history. On June 12, 2026, SpaceX officially went public under the ticker symbol SPXC, raising approximately $75 billion. Retail and institutional demand was so high that it pushed the company's valuation to the $2 trillion mark within hours of the market opening. This chart shows the scale of that valuation compared to other historic debuts. SpaceX entered the market larger than Meta, Alibaba, and Visa combined, a figure that exceeds the entire annual GDP of many mid-sized countries. A $2 trillion valuation means the market is already pricing in decades of future success. This creates a specific tension. The company's momentum is historic, but the financial risk of buying at this level is equally real. Most people see the name SpaceX and immediately think of the hardware, Falcon 9, Starship, and the long-term goal of reaching Mars. However, rocket launches require massive, continuous capital expenditure. To reach a $2 trillion valuation, a company needs higher margins than space transportation typically provides on its own. The business actually operates in three distinct industries. Space transportation provides the brand recognition, but the business model also relies on global internet infrastructure and artificial intelligence. These hidden pillars are what turn a launch provider into a high-growth tech firm. Investors are really buying into a network that spans the globe and a software system that manages it. To evaluate the stock accurately, you have to stop viewing SpaceX as a space explorer and start analyzing it as a borderless telecom and infrastructure giant. The actual financial engine driving the SpaceX brand today is Starlink. By launching thousands of satellites, SpaceX created a global internet network accessible to remote areas, maritime fleets, and military operations that traditional providers cannot reach. This setup bypasses traditional localized infrastructure. While older satellite systems were limited by geography, Starlink relies on a standardized receiver that can link into the orbital grid from almost anywhere. Every new subscriber represents recurring revenue. This is money that comes in every month, creating the kind of predictable cash flow that Wall Street values most. High valuations are usually built on this mathematical predictability. The more subscribers SpaceX signs up, the easier it is for analysts to justify a multi-trillion-dollar price tag. However, securing that cash flow requires constant maintenance. Those satellites have to be regularly replaced and upgraded, which means the company must continue funding expensive rocket launches indefinitely. The $2 trillion valuation is a bet on Starlink's ability to scale its subscriber base faster than it spends money on maintaining its orbital network. This comparison shows how Starlink's expansion model differs from traditional companies like Comcast or AT&T. Traditional ISPs are limited by physical expansion. They have to dig trenches and get local approvals for every new street they want to service, which is both slow and expensive. That physical reality means their growth is tethered to the ground, relying on miles of cable that restrict how many customers they reach at once. In contrast, Starlink grows its total market with every orbital launch. They can activate service for entire regions from space, rather than going street by street. While a terrestrial tower only reaches a specific local area, a space-based network ignores geographic boundaries and provides coverage across entire continents. But avoiding local zoning means taking on a different kind of risk. SpaceX now has to navigate complex international regulations and manage the logistics of an increasingly crowded orbital environment. Starlink has the entire planet as a potential market, but its success depends on managing global geopolitics as effectively as traditional giants manage local permits. We also have to consider the leadership premium that investors have added to the stock price. Elon Musk's track record with Tesla and PayPal has built a level of trust with retail investors. They are betting on his ability to establish massive new industries before competitors even recognize the opportunity. This trust leads to a concept called pricing in perfection. The current valuation assumes that Starship will be a total success and that future AI networks will be immediately profitable. This makes the stock vulnerable. Because expectations are set so high, any technological setback or volatile public statement by the CEO could trigger a sharp drop in value. Buying SpaceX today means accepting that the stock price relies as much on unproven future technologies as it does on current telecom revenue. There are also long-term risks to consider, including competition from well-funded rivals like Amazon's Kuiper project, which is aiming for the same global market. This scorecard illustrates the execution risk. To justify the $2 trillion price, SpaceX must commercialize industries that don't yet exist. The technical risk is most significant. Starlink's profitability depends on Starship achieving high-volume launches. If that stalls, financial margins suffer. Historically, even the most successful companies experience massive price pullbacks when their growth begins to slow or fails to meet astronomical expectations. Investing in innovation requires accepting extreme uncertainty. Great companies often see their IPO prices inflated by initial hype before settling into a more realistic valuation. Consider this decision tree based on your risk. Worried about missing out? Wait for post-hype depths. Growth optimizer? Dollar cost average over time to smooth out your price. Value investor? High execution risks make this a definitive pass. Information creates opportunity. Ignore the hype surrounding the launches and only invest if the mathematical reality of a borderless telecom company fits your financial goals.